On my daily walk today, and I was going to tell you why are interest rates moving up and what are the tariffs doing to that specifically. So I think the best way to explain it is that the tariffs bring money in, right? And so when this tariff stuff happened, if you don't know what a tariff is, it's just tax on imports and exports. So every country taxes stuff coming in. So we send stuff to China, they tax us. They send stuff to us, we tax them. You're seeing it all in the news, and that's what's kind of the big story, right? So what's happening and why that's affecting interest rates. As the tariffs are in place, the economy right now is slowing down because less people are importing, less people are exporting with all of that going on. And specifically, how that affects the interest rates are that those taxes help with some of the government programs like Social Security or whatever else the government needs money for, which is pretty much everything they do, right? The government needs money, and what they do is they issue bonds. And a bond is essentially the ability for the government to borrow money from private citizens. You know, big corporations will buy bonds, people like you and I will buy bonds, and it's almost a guaranteed return on those bonds. So they'll say, hey, we'll sell you this bond for X amount of dollars, and you'll get a 3% return or a 4% return. So this really has not a ton to do with the Fed. It does a little bit, but I won't get into all that stuff. But they issue these bonds in order to cover the money that they don't have for whatever they're spending money on at that point. So here's how it affects interest rates specifically is you'll hear a lot of people talk about the 10-year treasury yield, which is essentially government bonds that go out for 10 years and they come to maturity, which means that you get all your money back at the end of the 10 years. But when people buy the bonds from the government, they can then trade them on the market openly, back and forth. People pay X amount of dollars for one, and the cheaper the bonds are, the better the return, right? Because if you buy it at $1,000 and you're getting a 3% return, then you sell it, but you can only sell it for $500, then you're buying it for a lot less with that same return that originally was paid at $1,000. Now people are trading these and selling them for less money now than they had been. And what that means is you're getting a better return, and your return is pretty much guaranteed based on whatever you purchase, because the money's guaranteed by the government. It's a loan to the government, and the government is, you know, unless there's a collapse of the government, it's guaranteed to come back. So what happens is mortgage interest rates, investors are the ones who control the interest rates on mortgages, and investors are the ones who buy bonds. So when they look at a bond, they say, what is my return? Can I make pretty good money on a bond? And because bonds have no risk, essentially, it means you put your money in, you get your money out, they are usually a little bit less than what a mortgage interest rate would be. Because a mortgage, if you put your money into, they call them mortgage-backed securities, don't worry about all that. It just basically means that you're loaning money to big people who loan money out to little people that buy houses with that money. And when a person buys a house, if they don't pay back that mortgage, then the people who originally had lended the money, they lose money, right? Then that interest rate that they're getting on the money they loaned doesn't mean anything, which means it's a higher risk. So the mortgage industry, investors typically look at the bonds that the government offers and look at the return or the money they can get out of that and compare it with mortgages, because mortgages are somewhat safe, but there is risk. That risk being that people could potentially not pay their mortgages back, and then investors would lose their money. So if an investor wants to make money, it doesn't make sense to put your money into mortgages when you can just loan it to the government and make more money back. So then the interest rate on mortgages have to be priced higher so that those investors are more likely to put money into it in order to loan it out. And that's essentially how interest rates go up and down. And, you know, the government, the way that this is kind of off the topic, that's essentially why your mortgages go up and down. Sometimes the government will control the interest rates by, they make these loans, and then the Federal Reserve, which is like a pseudo government organization, will buy those loans and sell them